When a loved one passes, the emotional weight can be overwhelming, and taxes are rarely the first thing on your mind. Yet without a clear plan, the Internal Revenue Service could claim a significant portion of your family's legacy. In this video, we'll demystify estate and inheritance taxes, what they are, how they differ, and why planning now is more important than ever. We'll also explore what's changing in 2025 and 2026, and how proactive strategies can help your family preserve wealth and peace of mind. By the end, you'll have a step-by-step roadmap for protecting your real estate and the legacy your family has built. To begin, it's important to understand the difference between estate tax and inheritance tax, because the two are often confused. The estate tax is paid by the estate itself before any assets are transferred to heirs. It applies to the total value of the deceased's property, investments, and other holdings. On the other hand, inheritance tax is paid by the beneficiaries after they receive their inheritance, but this tax only exists in a few states. Currently, just 5 states impose an inheritance tax: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. The federal government does not levy one. That means if you inherit property located in Texas, there's no inheritance tax. But if that property is in Maryland, different rules may apply. The federal estate tax, however, affects estates exceeding the exemption threshold, with rates reaching up to 40%. Why timing matters more than ever? Estate planning is not only about what you own, it's also about when you act. Timing plays a crucial role in determining how much of your estate remains intact. As of 2025, the federal estate tax exemption stands at $13.99 million per individual and nearly $27.98 million for married couples. Beginning in 2026, this exemption is expected to increase to $15 million per person or $30 million for couples under the updated provisions of the One Big Beautiful Bill Act. While this increase offers breathing room, it may be temporary. Future legislative adjustments could lower the threshold again, pulling more families into taxable territory. Estate tax planning is most effective when it's proactive, not reactive. What counts in an estate more than you think? When the IRS determines the value of an estate, it looks far beyond real property. An estate may include real estate and land holdings, investment portfolios and brokerage accounts, business interests or partnerships, retirement funds and annuities, life insurance proceeds. The executor's job is to total the estate's value, subtract debts and eligible deductions, and file a federal estate tax return, typically within 9 months of the date of death. Building an effective estate tax strategy. Taxes may be inevitable, but overpaying them is not. A thoughtful estate plan integrates financial strategy, family goals, and compliance requirements into a single, cohesive framework. Here are 5 proven methods to reduce exposure and safeguard your estate. 1. Lifetime gifting. Transfer appreciating assets while you're still alive. 2. Trust planning. Utilize irrevocable trusts to remove assets from your estate, or revocable trusts to streamline management. 3. Charitable giving. Establish charitable remainder trusts or foundations that allow you to support causes you value while lowering your taxable base. 4. Liquidity planning. Maintain accessible funds, often through life insurance or credit lines. 5. Documentation discipline. Keep updated appraisals, cost basis records, and improvement logs. When the IRS requests verification, well-maintained records can prevent disputes and protect deductions. Estate tax planning is not just about reducing liabilities, it's about maintaining flexibility and preserving family harmony through organization and foresight. Real estate, the core of most family estates. For many families, real estate represents the majority of generational wealth. That's why property-specific planning is essential. When real estate is transferred at death, it generally receives a step up in basis. This means the property's value resets to its market price on the date of death. For example, if a parent purchased a property for $300,000 and it's worth $1 million at the time of their passing, the heir's new basis becomes $1 million. If the property is sold immediately, the taxable gain is minimal, resulting in substantial savings. However, this benefit is often lost when appraisals aren't conducted promptly or when documentation is incomplete. Multi-state or cross-border estates require additional coordination to align filings across jurisdictions. A common area where unplanned unplanned estates face disputes or penalties. Avoiding costly estate planning mistakes. Even the most diligent families can make mistakes that invite complications or reduce asset value. Common errors include missing filing deadlines for federal or state estate tax returns, incomplete appraisals, or missing cost basis documentation. Underestimating liquidity needs to cover estate taxes. These oversights can lead to forced property sales or financial strain at the worst possible time. The solution lies in preparation. Keep your estate plan updated, review your documents annually, and involve qualified professionals to ensure accuracy. Your 2025-2026 estate planning roadmap. Here's a clear action plan to protect your estate in the years ahead. Step 1. Compile a comprehensive inventory of assets, liabilities, and ownership records. Step 2. Obtain updated appraisals for all real estate and business holdings. Step 3. Consult a qualified real estate tax advisor to model federal and state exposure. Step 4. Establish or update your trust and will to reflect current laws. Step 5. Liquidity plan. Identify funding sources to cover taxes and expenses. Consistent reviews are the key to preventing future complications and maintaining control over how your assets are preserved and distributed. Why partner with GavTax Advisory Services? At GavTax Advisory Services, we help families bring order and confidence to complex financial transitions. Our team coordinates valuations, filings, liquidity strategies, and tax planning within a single framework, ensuring executors, heirs, and advisors work in harmony. Whether you're managing an estate in Houston or handling properties across multiple states, we provide the expertise to minimize tax exposure, maintain compliance, and safeguard your family's legacy. Because at GavTax, we understand that estate planning isn't only about numbers, it's about honoring what that wealth represents, your family's hard work, history, and future. Don't wait until a deadline approaches to take action. Begin now. Understand your options, document your assets, and secure expert guidance. Visit GavTax.com to schedule your personalized estate tax strategy session today, because your legacy deserves protection, not uncertainty. See you in the next video.